Ever tapped your card, or maybe even just your phone at a store or online, and wondered about the colossal, sort of invisible engine making that transaction happen behind the scenes?
Hmm.
Well, today, we're taking a truly deep dive into a company that touches almost every financial interaction on the planet, Visa.
Everywhere, isn't it?
It really is. And we've gathered an incredible stack of sources for this deep dive. Everything from their latest Q3 2025 earnings call, a detailed financial report laying out their numbers.
Right, the nitty-gritty.
Exactly. Plus an insightful investment retrospective and even a pretty bold analysis that doesn't just critique but questions its very market structure.
Yeah, that one pulls no punches.
No, it doesn't. We're talking about Visa, ticker symbol V on the NYSE,
Right.
a company that, well, one of our sources projects could have a remarkable 76% 5-year potential upside.
76%. That's quite a projection. So our mission today is really to unravel the many layers of this payment giant. We'll look at not just what Visa is doing day to
The
day.
transactions, the tech.
Exactly. But why it's able to achieve such incredibly robust profitability. We'll explore how it's actively innovating, adapting in these really cutting-edge spaces like, artificial intelligence and stablecoins.
Stablecoins, yeah, that's fascinating.
And crucially, we'll examine the significant, sometimes controversial, market position it holds globally.
Hmm.
You'll walk away, hopefully, with a comprehensive understanding of a company that truly shapes modern commerce. It acts in many ways as the ultimate hyperscaler for money movement.
That concept, the hyperscaler, that's something we'll really dig into, whether you're curious about the future of money, maybe you're tracking big tech, or you just love a good business story that reveals how the world actually works.
Which this definitely does.
Oh, yeah. This deep dive is for you. Get ready for some serious aha moments, because there's definitely a lot more to Visa than meets the eye.
All right, let's do it.
Okay, let's unpack this. Let's start with Visa's recent fiscal third quarter 2025 results. They were announced July 29, 2025. You'll see some truly impressive numbers right out of the gate that really set the stage for our discussion.
What's immediately fascinating here, I think, is the sheer consistency and the scale of the growth. Visa delivered net revenue of $10.2 billion.
$10.2 billion just in one quarter.
Right. And that's a significant 14% year-over-year increase. What's interesting is it held true on both a nominal basis and, the raw dollar amount and a constant dollar basis, which kind of smooths out currency fluctuations.
So real underlying growth there.
Exactly. It gives us a clear picture of their organic growth. And their non-GAAP diluted earnings per share, EPS, that jumped an even more impressive 23% year-over-year to $2.98.
23% EPS growth. Okay, maybe quickly for listeners, non-GAAP versus GAAP.
Good point. So non-GAAP earnings often exclude one-time things like maybe a big litigation charge or non-cash items. It aims to give a clearer, more consistent look at the core operational profitability.
Right, the day-to-day business.
Yeah. Well, diluted just means it factors in all potential shares, giving investors a more conservative view of earnings per share. So these numbers, they aren't just isolated jumps. They're really a robust reflection of underlying business strength across their pretty diverse model.
Those are some really strong top-line numbers. Impressive. But what are the foundational metrics driving this? What's actually moving through their network?
Absolutely. That's where you see the engine working.
Yeah.
The foundational metrics that drive Visa's business, the actual volume, the number of transactions, they all showed really robust performance. Global payments volume, for instance, grew 8% year-over-year in constant dollars.
8% growth in just the value moving around.
Yep. And this isn't just about more people getting cards. It's about the increasing digitization of commerce worldwide. That's a huge trend Visa is perfectly positioned to ride.
Makes sense. And the number of times people actually used Visa.
That also saw a substantial increase. Overall processed transactions climbed 10% year-over-year. They get a staggering 65.4 billion.
65 billion in 3 months.
Billion. With a B. Yeah. That's hard to even wrap your head around. That's 65.4 billion times someone swiped or tapped or clicked with a Visa credential.
That's almost unimaginable. I mean, doing quick math, that's roughly, 7,000 transactions every second?
Something like that, yeah.
Yeah.
It's just continuous global activity.
And it's not just domestic transactions, right? I mean, cross-border movement, that's a massive and usually highly profitable part of their business. How did that look?
Indeed. And it was a strong performer this quarter. Cross-border volume, if you exclude intra-Europe transactions,
Mm,
which are treated a bit differently because of specific regional rules,
right.
that was up a strong 11% year over year in constant dollars.
11%. Okay.
And when we look at the total cross-border volume, including intra-Europe, it's on an increase of 12%. This really points to a robust resurgence in things like international travel, global e-commerce.
Stuff that took a hit during the pandemic, maybe.
Yeah, it's exactly. It shows Visa's critical infrastructure in global money movement is humming again. These figures really underscore the interconnectedness of the global economy and how Visa facilitates so much of that interaction.
Mm.
Whether it's a tourist paying for a souvenir in a foreign country or an online shopper buying something from an international merchant.
So these aren't just big numbers floating in space. They tell a story of immense scale, deep global integration. It's really about how much the entire world relies on their network for just daily commerce, connecting buyers and sellers across continents.
Yeah, and if we connect this to the bigger picture, how they make money. Visa's revenue comes from several key engines, and the good news for them is all of them showed strong growth this quarter.
Okay.
At its core, you should think of Visa not really as a bank that lends you money, right?
Yeah.
They're more like the world's most sophisticated digital toll road.
Toll road. I like that analogy.
Yeah. They connect hundreds of millions of consumers, millions of merchants, thousands of financial institutions, and their revenue largely comes from taking a tiny toll, basic a processing fee every single time a vehicle or a transaction travels across their network.
Gotcha.
And also by offering value-added services along the way. It's definitely not a one-trick pony. It's a really well-oiled machine with multiple revenue streams contributing to its overall health.
Okay, let's break down those engines then. What are the core ways Visa generates this revenue, and how did they perform specifically this quarter?
All right, first up, we have service revenue. That clocked in at $4.3 billion, and it was up 9% year over year.
Okay, $4.3 billion. What exactly is service revenue based on?
Good question. This revenue is recognized based on the prior quarter's payments volume. So it reflects the consistent, almost habitual usage of their network. It's kind of a steady stream derived purely from the sheer scale of global spending.
Okay, so that's backward-looking volume. What else?
Then there's data processing revenue. This was even bigger, hitting $5.2 billion and up an impressive 15% year over year.
15% growth there. What drove that? Just more transactions?
That was part of it, yeah. The overall increase in those 65.4 billion processed transactions we mentioned, but it was also driven by strategic pricing adjustments.
Ah, so they're getting slightly more value per transaction, maybe.
Essentially, yes. It shows their ability to optimize their core service and maybe capture more value as their network becomes even more critical.
Makes sense. Okay, so service revenue, data processing. What about all those international payments we talked about? Where does that show up?
That falls under international transaction revenue. It came in at $3.6 billion, up 14% year over year.
14%. Strong.
Very. And this is directly tied to that growth in cross-border volume we discussed earlier.
Yeah.
Interestingly, it was also impacted by currency volatility. Sometimes that could be a headwind, but in this quarter, currency movements actually contributed positively to this revenue stream.
Huh. Okay. So currency can cut both ways for them.
Absolutely. And finally, there's other revenue. This segment saw a really significant jump. It was up 32% to hit $1.0 billion.
Wow. 32% growth in other. What's in there?
This is primarily stemming from things like advisory services, consulting, data analytics, basically other value-added services they offer to their clients like banks and merchants.
Okay.
So this segment really highlights their successful diversification beyond just the core transaction processing. It shows their broader utility to clients, which we'll talk more about later.
So it's clear it's not just one area carrying the load. It's really a multifaceted revenue machine firing on all cylinders. Every part of their business seems to be contributing meaningfully to the bottom line. That's exactly what you want to see in a powerhouse company like this.
Yeah, absolutely. But this naturally raises an important question.
Yeah.
What about the costs? What does it cost to run a business at such a massive global scale?
Right, because revenue growth is great, but you need to manage expenses for that profit.
Exactly. So their non-GAAP operating expenses were up 13% year over year. This was primarily due to increases in personnel costs, hiring and retaining talent, and general administrative expenses, which is pretty understandable for a growing global company investing in its workforce and infrastructure.
Okay, 13% increase in non-GAAP costs. seems reasonable given the revenue growth.
It does. However, their GAAP operating expenses showed a much larger jump, up 35%.
Whoa, 35%? What caused that big difference?
That was largely due to a substantial $615 million litigation provision.
Ah, okay. A one-time adjustment for legal stuff.
Right, a significant one-time adjustment related to ongoing legal matters. And this distinction is important, right, because the non-GAAP figures aim to show the underlying kind of recurring operational health, while the GAAP figures have to include these unique non-recurring events.
Gotcha. That litigation provision certainly stands out, though. It's a reminder that even really dominant companies face significant legal challenges. But what about client incentives? That's always seemed like a huge, slightly opaque part of their business, how they manage relationships with banks and financial institutions, often by giving them a cut of the revenue, right?
Indeed. It's a critical lever for them. Client incentives amounted to $4.0 billion this quarter. That was up 13% year over year.
$4 billion in incentives? That's massive.
It is, but what's particularly interesting here, though, is that this figure was actually lower than what Visa had initially expected.
Oh, why was that?
The primary reasons they cited were shifts in the timing of specific deals coming through and also some one-time reductions that resulted from expanding relationships with certain clients. So maybe they negotiated better terms in exchange for a broader partnership.
Interesting.
This isn't just a simple line item. It really represents a dynamic negotiation process. Long-term, deeper relationships with financial institutions and big merchants can lead to adjustments in these incentives. These incentives are absolutely critical to their business. They help secure and deepen partnerships, ensure network loyalty, and drive card issuance and usage.
It really seems like managing those client relationships and the associated incentives is a delicate dance, impacting the bottom line in, well, surprising ways sometimes. It's not just about winning new business, but strategically optimizing the existing ones to drive long-term value, maybe for both sides.
Well put. And from a shareholder perspective, Visa is actively returning value,
Yeah.
which is usually a strong sign of financial health and management confidence.
How are they doing that? Buybacks? Dividends?
Both. During Q3, they repurchased approximately $4.8 billion worth of their own stock.
$4.8 billion in buybacks in one quarter.
Yeah, buying back 14 million shares at an average cost of about $349 per share. This is a substantial capital return program, especially when you consider they still have nearly $30 billion remaining in their buyback authorization.
$30 billion left. Wow.
Yeah, it signals a continued commitment to reducing the outstanding share count, which, mechanically boosts earnings per share for the remaining shareholders.
And beyond buybacks, they also maintain a steady dividend for investors, don't they? Providing that regular income stream.
They certainly do. Visa distributed $1.2 billion in dividends during the quarter. They declared a quarterly cash dividend of $0.59 per share, which is payable on September 2nd, 2025.
Okay.
This consistent dividend payout, alongside those aggressive share repurchases, really underscores their robust cash generation capabilities. It demonstrates their financial discipline and commitment to both growth investments and direct shareholder returns. Makes it an attractive option for, a wide range of investors.
Looking ahead then, what's their outlook? They seem confident based on these numbers.
Yeah, looking ahead to Q4 2025, Visa expects adjusted net revenue and operating expense growth to be in the high single digits to low double digits range.
So still strong growth projected.
Yep. Similarly, EPS growth is also projected in the high single digits. And crucially, they anticipate finishing the fiscal year 2025 stronger than they initially expected. That's a confident outlook, especially considering all the global uncertainties floating around. That confidence seems to extend into their longer-term planning, too, looking well beyond just the next quarter. Management mentioned they're already rigorously evaluating various macroeconomic scenarios, planning for crucial client renewals down the road, and strategically prioritizing investment decisions for fiscal year coming 26.
So thinking a year or more ahead already.
Exactly. This forward-looking approach signals a pretty robust strategic vision for sustained multi-year growth. They are focusing intently, they said, on their three core growth engines: consumer payments, commercial and money movement solutions, and those value-added services we touched on.
Right.
It reflects an understanding that in this rapidly evolving market, proactive planning, continuous investment in their network, and deepening those client relationships are absolutely key to maintaining their leadership position.
Okay, here's where it gets really interesting and maybe a little provocative. One of our sources expressing some strong sentiment describes Visa's financials as too incredibly good. They actually write, and I'm quoting here, too fucking good.
Wow, okay, strong words.
Yeah, that kind of language really highlights just how anomalous these numbers seem to some analysts. What could possibly make a business look so exceptionally profitable that it almost defies belief?
That statement, it truly highlights Visa's unique and almost unparalleled position in the global economy. The source points out an astonishing net profit of 55% after tax.
55% net after
Yeah,
tax.
let that sink in. To put that into perspective, for every single dollar they bring in revenue, 55 cents is pure profit after all expenses and taxes are accounted for.
That's incredible.
This kind of profitability, especially at Visa's massive scale, and for a publicly traded company,
Yeah.
it's described in the source as insane and virtually unheard of.
Mm.
You compare this to, say, a top-tier manufacturing company, they might see net margins in the high single digits, maybe low teens if they're lucky.
Right, or even big tech.
Even a highly successful tech company might hit, 20, 30% net margins. Visa is just in a league of its own. It speaks volumes about their operational efficiency and, as we'll definitely get into, their significant market power and the unique structure of their business.
So 55 cents on the dollar after tax, that's a number that really makes you double take and underscores their financial power. And what about their gross margins? Before operating expenses, are they equally impressive? Maybe even software-like.
Absolutely. That's another key point the source highlights. Visa has maintained incredibly consistent 80% plus gross margins over the last decade.
80% plus gross margins. Yep.
Yep. To put that in perspective, these are figures typically associated with top-tier software companies, right? Where the cost of goods sold is minimal.
Because it's mostly code, not physical stuff.
Exactly. This means their core service, processing those billions of transactions, is incredibly efficient and capital light once the infrastructure is built. Unlike a traditional manufacturer that has high raw material costs, production costs, or a retailer with inventory and physical store overheads, Visa's product is essentially a digital network.
The digital toll road again?
Precisely. Once that road is built and paved, the incremental cost of letting another billion cars or transactions drive over it is exceptionally low. It's an extraordinary testament to their dominant platform and its inherent leverage.
Okay, so they have software-like margins, but critically, are they spending like a software company? I mean, think about Salesforce, right? Constantly pouring billions into R&D, into sales, just to stay competitive, to evolve its product. Is Visa doing the same? Constantly retooling and innovating at that kind of massive spending level?
No. And this is where Visa deviates dramatically. It's a key part of that too good to be true argument, and frankly, where we need to reconcile some seemingly conflicting information from our different sources. The source highlighting the insane profitability points out that Visa spends less than 20% of its gross profit on operating expenses,
Less than 20%.
which is described as unheard of for a company of its size and reach. Even more strikingly, that particular analysis reports Visa spending a whopping $0 on traditional R&D in the last 5 years.
$0 on R&D for a company calling itself a global payments technology company.
I know, it sounds contradictory, right?
Yeah.
And this is in stark contrast, as the source points out, to an actual software company like Salesforce, which typically spends about 20% of its gross profit on R&D and a massive 70% or so on SG&A selling, general, and administrative expenses.
Wow, 0 on traditional R&D for 5 years, according to that analysis. That's almost mind-boggling for what they claim to be. But then we just heard from their earnings call about all this vivid innovation they're doing. AI, stablecoins, flex credentials. How do we square that circle? Is one source just plain wrong, or is there a nuance here we're maybe missing?
That's a fantastic observation, and I think it highlights a really critical distinction in how companies define and, maybe more importantly, account for innovation.
Okay.
When that one source points to 0 R&D spending, it's likely referring to a very specific accounting line item, usually for fundamental, maybe speculative research and development, the pure R part of R&D, you could say.
Like inventing something totally new in a lab.
Exactly.
Yeah.
However, Visa's innovation strategy, which is clearly evident in their earnings calls and announcements, it isn't really about ground-up scientific invention in a lab. It seems much more akin to a master architect continuously enhancing and expanding a colossal already built city.
Ah, okay. Improving the existing infrastructure.
Precisely. They are investing heavily, it seems, in strategic development and integration. This means they might be acquiring cutting-edge technology companies, they're investing in partnerships with fintechs and startups, and they're continuously upgrading their existing platform and infrastructure to embed new capabilities like AI, like tokenization, like stablecoin support.
So the spending is happening, just maybe not categorized as R&D in the traditional accounting sense.
That seems plausible.
Right.
While they might not show typical R&D outlays on that specific line item that the source focused on, they are absolutely evolving their Visa as a service stack, as they call it, to lead in these new areas. It's just happening through a different operational and financial model, one that's maybe more about deployment, integration, and enhancement rather than pure discovery.
That's a really important clarification. It suggests they've built this incredibly durable, almost unassailable system, and their innovation is more about leveraging and expanding that existing infrastructure rather than constantly reinventing the wheel.
I think that's a good way to put it.
Yeah.
And what about capital expenditures? Are they pouring money into building out physical assets, data centers, things like that? Or is that also incredibly efficient?
According to the financial analysis we looked at, it reveals an incredible return on capital expenditures, too. Over a 10-year period, Visa apparently spent about $7.8 billion on capital expenditures.
Okay, $7.8 billion over 10 years. Doesn't sound huge for a global tech company.
Right. Yet, this relatively modest investment generated a staggering $150 billion in earnings over the same period.
Whoa, $7.8 billion in, $150 billion out.
Yeah, that's an astonishing return the source calculated. It's like putting $1 into a machine and getting $19.16 out.
19 times return on CapEx. Okay.
This level of capital efficiency further underscores their unique business model. Once that core digital network is established and operational, it just generates immense returns with relatively minimal ongoing investment compared to other industries that need constant, heavy capital deployment for new factories or equipment or physical expansion.
It truly speaks to a business that is fundamentally built to scale and profit, without the constant need for those expensive traditional innovation cycles or heavy asset bases.
It's almost like they've built the ultimate money printing machine, like you said, and now it just keeps generating returns without needing constant retooling or massive new injections of capital. You can definitely see why a source might use strong language like too fucking good to describe these financials.
Yeah, it makes sense in that context.
So this prompts a critical question. How does a company maintain such dominance with seemingly minimal traditional innovation spending, according to one view, and such lean operations overall? Visa itself, well, they attribute their success to their powerful brand, their strong track record, and deep customer loyalty.
And those are certainly factors. You can't deny the power of the Visa brand.
Absolutely. But given those staggering profit margins we discussed earlier, 55% after taxes, customer loyalty, and brand really enough to explain that kind of financial performance, wouldn't a skeptic argue there must be more structural advantages at play? Perhaps even something less benign. This is where the M word inevitably comes in, right? The idea that this extreme profitability might not just be a result of good business, but potentially a function of significant market power.
That's a crucial point, and it's precisely where the external critiques of Visa begin to intersect with its undeniable financial success. While brand and loyalty are certainly factors, the sheer scale and consistency of Visa's profitability, combined with that unique capital efficiency and, let's call it, non-traditional R&D approach,
Right.
it does suggest something more fundamental about its market structure.
Right.
It raises questions about how much genuine, intense, day-to-day competitive pressure it truly faces, and whether its market position is more than just being best in class. This naturally leads us right to the heart of the M-word, monopoly concerns.
That's a perfect segue because, despite the claims of no R&D from one source, Visa's earnings call, as we discussed, paints this vivid picture of ongoing strategic innovation in consumer payments.
Right, the enhancement and integration model.
Exactly. This isn't about traditional R&D, perhaps, but about continuously refining and expanding their Visa as a service stack. So, how are they staying ahead in this rapidly evolving space? What specific innovations are they highlighting to investors and clients?
Yeah, their approach seems less about ground-up invention and much more about strategic development and integration into their existing, incredibly robust network. They're aggressively transforming the way people pay by embedding new technologies into their ecosystem and just leveraging their massive global scale.
Okay, like what specifically?
A major focus is digital transformation, making sure their core offering stays at the cutting edge. They're seeing strong growth, for example, in tokenization. Total credentials tokenized were up 7% year over year,
7th% growth in tokens.
and that marks the ninth consecutive quarter of at least 7% growth in that area. They are apparently nearing 15 billion tokens in circulation globally.
15 billion tokens.
And get this, over 50% of all e-commerce transactions globally are now tokenized using their standards.
Over half of online shopping is tokenized. Okay, maybe for our listeners, just quickly remind us, what exactly is tokenization and why is it such a big deal for them?
Sure, think of tokenization as basically transforming your actual credit card number, that 16-digit number on the plastic, into a unique encrypted digital placeholder or token.
Okay.
So instead of transmitting your sensitive card number during an online purchase, only this unique, one-time use or merchant-specific token is sent. If a merchant system is ever compromised, hackers only get this useless token, not your actual card details.
So it dramatically increases security.
Exactly. It drastically increases transaction security, and it also simplifies the payment experience for you as a consumer, because you often don't have to re-enter details repeatedly across trusted sites or devices. Their stated goal, they said on the call, is to eventually reach 100% penetration in e-commerce, making online shopping incredibly secure.
Right, taking the actual card number out of the flow as much as possible. That's a huge number of tokens deployed already. What else are they doing to adapt the actual card experience for today's more diverse financial needs?
Well, they're heavily pushing their Flex credential. This is described as a crucial solution designed for more diverse use cases. Think about the rise of buy now, pay later options,
Like PPL.
or the complex needs of small businesses managing expenses, or even multi-currency transactions for global consumers. Flex Credential provides the underlying technology to support these different functionalities on a single credential.
So one card could potentially act like a debit card sometimes, a credit card other times, maybe even a BNPL tool.
That's the idea behind the flexibility. A notable partnership they announced this quarter is with Klarna. Klarna is launching a Klarna card powered by Flex Credential in both the US and Europe.
Klarna is a big name in BNPL.
Huge. And Visa says they have a pipeline of over 200 client opportunities globally for this Flex Credential technology, which indicates pretty broad applicability across various financial products and services.
So it's about making the card itself more versatile, allowing it to adapt to different financial products and specific customer needs in the moment. And they're even getting into AI for shopping, right? Enabling entirely new kinds of commerce experiences.
Exactly. They're actively developing Visa Intelligent Commerce. The aim here is to enable consumers like you and me to eventually shop and buy things using AI agents.
AI doing the shopping for you.
Potentially, yeah.
Yeah.
Or at least assisting significantly.
Yeah.
This isn't science fiction. They're building it now.
Yeah.
It combines a suite of integrated APIs, which are essentially software connectors, with AI-ready cards that have advanced tokenization and authentication built in, and a commercial partner program for AI platforms.
Okay. Is this live yet?
They said over 30 partners are already testing this in a live sandbox environment, with general availability expected later this year. This really signifies their ambition to be at the forefront of what they're calling agentic commerce, where AI assists or maybe even executes purchases on your behalf securely using the Visa network.
That's definitely a glimpse into the future of shopping. Wild.
What about in the physical world, though? Face-to-face transactions, are they still pushing hard to digitize cash there, making payment even more effortless?
Oh, absolutely. Tap to everything is a major initiative for them, still driving cash digitization and habituation. Tap to pay penetration, they reported, is now at an impressive 78% of face-to-face transactions globally.
78%. Wow, so tapping is really becoming the default.
It really is. They've seen remarkable growth, specifically in the U.S. They mentioned 75 U.S. cities are now at 60% tap-to-pay penetration or higher. That's up from just 30 cities last year.
That's rapid adoption.
Incredibly rapid. Even major hubs like New York City and San Francisco have surpassed 85% and 80% penetration, respectively. A lot of that growth is driven by public transit initiatives adopting tap-to-pay.
Right, like tapping onto the subway. Exactly. So essentially, we're becoming a society of tappers. I was just in New York last week, actually, and you couldn't help but notice it. Everyone, everywhere, just tapping their phone or card, even for a quick coffee or a street vendor.
Yeah.
It really hammers home how quickly these habits shift once the infrastructure is there, and it's easy.
It truly does. It just becomes second nature so fast.
It does. Furthermore, Tap to Phone added a record 3 million transacting devices this quarter.
Tap to phone? What's that again?
That allows small businesses, like maybe a market stall owner or a plumber, to accept contactless payments just using their existing smartphone. No need for a separate, dedicated payment terminal.
Making acceptance easier for micro merchants.
Exactly. democratizing payment acceptance.
Hmm.
And Tap to Add card is expanding rapidly too, with over 275 issuers participating globally now. That's almost double from last quarter. This makes it seamless for you to add your physical card details to a digital wallet, like Apple Pay or Google Pay, just by tapping the card to your phone,
So simplifying the whole process of getting cards into digital wallets,
making it frictionless.
it's clear it's not just about traditional plastic cards anymore. It's about seamlessly integrating Visa into every possible payment experience. Whether you're tapping your phone, maybe using an AI agent in the future, or even benefiting from new flexible credit options, they're really working hard to make their network the invisible, indispensable backbone of all modern commerce.
Absolutely. And beyond those consumer transactions, Visa is making really significant strides in commercial payments and money movement as well.
Right, the B2B side.
Exactly. Their Commercial and Money Movement Solutions segment, CMS, showed a strong 13% revenue rise year over year in constant dollars this quarter, and commercial payments volume itself was up 7%. This demonstrates their commitment to serving businesses of all sizes and facilitating those complex financial flows, everything from large corporations paying suppliers globally to small businesses just managing their day-to-day expenses.
Okay, so how are they achieving this growth in commercial payments? What specific platforms or solutions are driving it? It feels like it's moving way beyond just individual corporate cards.
Oh, definitely. Visa Direct is a huge cornerstone of this growth.
Hmm.
It's fundamentally transforming how money moves globally, not just for consumers, but for businesses too. This platform saw its transaction count grow 25% year over year to hit 3.3 billion transactions.
3.3 billion Visa Direct transactions.
Yeah. They position it as the largest money movement platform globally by transactions, volumes, and endpoints reached. Imagine the old way of sending money internationally for a business, often slow, expensive, involving multiple intermediary banks, tons of forms.
A real headache.
Totally. Visa Direct aims to transform that into something potentially as simple and instant as sending a text message. Whether you're a business paying a freelancer overseas, or a platform paying out earnings to gig workers, or an insurance company sending a claim payout, it's like creating a direct digital express lane for global money movement.
So Visa Direct is expanding its reach dramatically, becoming a crucial pipeline for all sorts of money transfers, not just P2P. Are they also building out more tailored solutions for specific industries within the commercial payment space?
Precisely. They're developing what they call vertical solutions to address very specific industry challenges. This shows how deeply they're trying to understand their clients' unique needs. For example, in healthcare and benefits, they mentioned providing solutions for employee benefits to over half the top HSA providers in the U.S. A recent example they gave was Sunny, a healthcare fintech, issuing Visa prepaid disbursement cards for health savings accounts.
Okay, tailored for healthcare payments. What else?
In the travel sector, they highlighted Checkout.com and Pliant utilizing Visa virtual cards specifically for online travel agencies. This helps simplify payments and spend management for things like hotel bookings and paying airlines or other suppliers.
Virtual cards for travel makes sense. Lots of specific transactions there.
Exactly. And for fleet and fuel management, think trucking companies or businesses with sales fleets. Their Fleet 2.0 solution offers advanced features like EMV chips for security.
The little chip on the card.
Right. Plus digital wallet provisioning, contactless payments. Octopus Energy in Europe was mentioned as a new partner, using this to manage mobility expenses for their fleet.
It really sounds like they're deeply embedding themselves in the specific operational payment flows of diverse industries, not just providing a generic card anymore. What about cross-border commercial payments? Those can be notoriously complex and costly for businesses.
Yeah, they're heavily focused on enhancing cross-border flows using Visa Direct as well. It's facilitating international remittances and B2B payments through strategic partnerships. For instance, ADIB in the UAE uses it for their remit program, enabling quick and secure international money transfers for their customers.
Okay.
And they mentioned working with 4 banks in Bangladesh to streamline outbound cross-border payments from there. In the U.S. and Canada, PaySend, a money transfer company, is expanding its use of Visa Direct to include payouts to gig economy workers, payroll disbursements, and even accounts payable flows for businesses.
So using Visa's rails for all sorts of B2B and B2C cross-border payments.
Yeah, it further solidifies Visa's role in making global money movement faster, maybe cheaper, and certainly more efficient for a much wider array of users and businesses.
So it's really clear they're not just about the card networks anymore. They're embedding themselves into the entire digital payment ecosystem, even enabling non-carded solutions sometimes. That feels like a very clear strategic shift towards being a universal payment enabler.
I agree, positioning themselves to be the underlying infrastructure for all forms of digital money movement, not just card-based ones.
And their push into open banking and account-to-account A2A payments seems to really illustrate this broader ambition, right?
Absolutely. In the UK, for example, they have Visa A2A. This provides simpler, safer, and more secure account-to-account payments directly through APIs on the Visa developer platform. They already have several partners on board.
So connecting bank accounts directly for payments, potentially bypassing traditional card networks in some cases.
That's the possibility, yeah. And in Brazil, they have something called Visa Conecta. This actively connects with Pix, which is the hugely popular instant payment system down there.
Right, everyone uses Pix in Brazil.
Exactly. Visa Conecta helps facilitate open banking payments using Pix, particularly in e-commerce, where traditional card conversion might have faced challenges due to existing customer habits or friction. This shows their adaptability. They're willing to leverage existing popular payment rails like Pix while enhancing them with their own technology, security layers, and data capabilities.
That brings us back to those value-added services, or VAS. You mentioned they had one of their strongest revenue growth quarters ever, up a staggering 26% year over year. That's a huge jump. What's really driving that, and what exactly are these services that are becoming so crucial?
Yeah, 26% growth is really significant. It reflects a very deliberate strategic focus on three key levers that are transforming how they engage with clients, moving far beyond just processing the transaction itself.
Okay, what's the first lever?
Firstly, they focus on enhancing Visa transactions, basically making the existing payments that run on their network safer, simpler, and more reliable. Think fraud prevention tools, risk scoring, authentication services, data analytics around their own transactions. This foundational layer is about continuous improvement of their core offering, ensuring the network itself is best-in-class, robust, and secure.
Okay, so making their existing network even better and more secure, which inherently adds value for everyone using it. Makes sense. What's the second lever for these value-added services?
The second is enabling all payment types. This is where it gets really interesting. It means leveraging their value-added services, their expertise, their data, their security tools to support not just Visa card payments, but also potentially other card payments, account-to-account payments like we just discussed, and digital wallet payments.
Ah, so applying their tools even when it's not their card being used.
Potentially, yes. That prime example is their partnership in Brazil to help power Pix payments. Here, they're providing underlying technology and security for a non-carded payment rail. So even if you're not using a Visa card in that instance, you might still be benefiting from Visa's deep expertise in payments, infrastructure, risk management, or data insights.
Right.
This significantly expands their influence beyond their traditional card products and really positions them as a broader payment utility provider.
That's a significant shift, positioning themselves as an enabler for the entire digital payments landscape, not just their own branded cards. Okay, and the third lever, this is where they really go beyond payments altogether, isn't it?
It is. The third lever involves going beyond payments entirely. Here, Visa helps clients with a whole range of services, from marketing and loyalty programs to managed services for things like disputes, to deep data analytics and strategic consulting.
Consulting, like Visa acting as a consultant to banks.
Yeah, exactly.
Yeah.
Imagine a major bank like Caixa in Brazil. Visa isn't just processing their card transactions. They mentioned on the call they're actively working with Caixa to help them develop an entire super app for Caixa's 40 million customers.
Wow. Building a super app.
Yeah. This means Visa is leveraging its deep expertise in digital engagement, its vast data insights from seeing spending patterns, and its market knowledge to help Caixa retain and attract customers, going far beyond just payment processing. It solidifies Visa as an indispensable, almost full-service strategic partner.
That's a much deeper relationship.
Definitely. We also saw this with Aeon Financial Service in Japan, where they renewed a credit relationship, but also added consulting and marketing services. And with FinTech Chime in the U.S., which apparently utilized Visa's marketing services for its brand campaign during the NBA playoffs.
It really sounds like they're building this comprehensive suite of tools and services that makes them indispensable to their clients, almost regardless of the underlying payment method being used. They are truly becoming a full-service partner in the digital commerce ecosystem, leveraging their unique data and expertise in completely new ways.
I think that's exactly their strategic aim.
Okay, let's pivot now to a topic that's been buzzing lately, generating a lot of headlines. Stablecoins.
Ah, yes, the crypto connection.
Right. These are, cryptocurrencies designed to minimize price volatility, often by being pegged to a fiat currency like the US dollar. Visa seems to be taking a very deliberate, almost proactive approach here, rather than just dismissing this new technology. What's their official stance?
Well, Visa has actually been incredibly active in the stablecoin and broader crypto space for almost a decade now, which might surprise some people.
A decade. Wow.
Yet, they haven't just been observing. They're actively supportive of legislative efforts like the proposed Genius Act of the U.S. They view something like that as a key milestone for getting much-needed regulatory clarity in this nascent but clearly growing field.
So they want regulation.
It seems so.
Yeah.
From their perspective, that clarity reduces risk and actually fosters innovation.
Hmm.
Their core belief, as stated on the call, is that stablecoins have genuine potential to solve important payment problems, particularly in areas like cross-border transactions and for users in economies with volatile local currencies.
Okay.
And Visa sees its role here as providing what it always has for payments. Things like trust, common standards, connectivity, massive scale, and interoperability to this emerging ecosystem. They're positioning themselves as the secure, reliable bridge between traditional finance and the, well, decentralized digital asset world.
So rather than seeing stablecoins as some kind of threat that could maybe circumvent their network entirely,
Right.
they're leaning into it as an opportunity to expand their network and services, making themselves integral to this new frontier as well.
Exactly. That seems to be the strategy. They've identified clear product market fit, they believe, in two primary areas for stablecoins right now.
Okay, what are those?
First, in emerging markets, places where local fiat currencies can be highly volatile or where consumers lack easy and affordable access to a reliable foreign currency like the US dollar. Stablecoins, especially USD-pegged ones, can offer a stable store of value. And then Visa cards provide an easy, ubiquitous way to actually spend those stablecoins at merchants.
Ah, bridging the gap between holding a stable digital dollar and spending it in the real world.
Precisely. Effectively digitizing and stabilizing cash flows in those regions.
Yeah.
The second area is cross-border money movement, both for B2B payments between businesses and for consumer remittances, people sending money home.
Right, which is often slow and expensive now.
Exactly. Stablecoins could potentially enable significantly faster and cheaper transactions compared to the traditional banking rails, addressing those long-standing pain points in international payments, high fees, slow settlement times, lack of transparency sometimes.
That makes a lot of sense, leveraging stablecoins for stability and efficiency where it's arguably most needed. Are they actually deploying solutions in these areas already, or is this still mostly conceptual, future-looking stuff?
No, they are very much in deployment mode. Visa has already rolled out stablecoin-linked cards in many markets around the world. They're partnering with crypto companies like Bridge, Rain, and Banex to do this.
So, cards that let you spend stablecoin balances.
Yes, and since 2020, they've enabled users to spend over $25 billion in various cryptocurrencies through these partnerships, and that now explicitly includes stablecoins. This is all about leveraging their existing ubiquitous acceptance network, the millions of merchants that already accept Visa, to make stablecoins practical for everyday spending. It effectively turns these digital assets into spendable currency anywhere Visa is accepted.
So it's really about leveraging their existing network to bridge that gap between traditional finance and this new digital asset class, making it accessible and usable for a wider audience right at the point of sale.
And it actually goes deeper than just the cards now. They are not just supporting stablecoins through cards, but actively building infrastructure to integrate them deeper into their actual network operations.
Oh, so?
Well, Visa is piloting partnerships with stablecoin payment companies. They mentioned Yellow Card in Sub-Saharan Africa as an example. The goal here is to help these companies streamline their treasury operations, improve their liquidity management, and facilitate quick and more cost-efficient cross-border transactions using stablecoins for settlement.
Ah, so bringing stablecoins into their core settlement capabilities for businesses, not just for consumer spending at the till.
Exactly. That's a significant step, moving beyond just consumer spending to the actual backbone of financial operations for businesses operating in the crypto space.
Are they also helping traditional financial institutions like banks engage with stablecoins too, or is it mostly focused on crypto-native companies?
No, they're definitely working with traditional players too. They are actively assisting banks, they say, in issuing their own stablecoins and harnessing the benefits of programmable money through their Visa tokenized asset platform.
So helping banks get into the stablecoin game themselves.
Yes, it's about empowering traditional financial institutions to participate safely and effectively in this new digital asset class. helping them understand and build on blockchain technology using Visa's tools and standards.
Hmm.
Furthermore, they've rapidly expanded their network capabilities for stablecoins just recently. They added support for a euro-backed stablecoin, EURC,
Okay, not just USD.
right, and they partnered with Paxos for 2 additional regulated stablecoins, USDG and PYUSD. They're also adding support for the Stellar and Avalanche blockchains.
Wow, that's a lot of expansion. Multiple coins, multiple blockchains. What does that mean in practical terms for their network? How many are they supporting now?
This means Visa now supports 4 different stablecoins, running on 4 unique blockchains. These represent 2 major fiat currencies, the US dollar and the euro, and these can be converted into over 25 traditional fiat currencies for settlement purposes within Visa's network.
Okay, that sounds incredibly ambitious.
Yeah.
They're really transforming their core settlement infrastructure to accommodate a multi-currency, multi-blockchain future.
It certainly seems that way. You can see how this could significantly expand their reach, making them a central hub for digital assets, just as they are for traditional fiat currencies today, thereby maintaining that hyperscaler position, as they call it, even in a rapidly evolving financial landscape.
Now, okay, we have to address the elephant in the room.
I knew this was coming.
When a business is this profitable, this dominant globally, and operates with such, well, lean efficiency, as one source described it, it often draws unwanted attention.
Almost inevitably.
And one of our sources explicitly calls Visa a monopoly, flat out. What's the basis for that very strong claim, and who is making these claims officially?
Yeah, this is a critical point that really underpins much of the debate around Visa's market position and those incredible profits. The Department of Justice, DOJ, in the United States, according to one of our sources and based on public filings, they view Visa as a monopoly.
The U.S. Department of Justice.
Yes, they allege, and I'm quoting some of the language used, exclusionary and anti-competitive conduct to undermine choice and innovation in payments. And they contend that this imposes enormous cost on consumers, merchants, and the American economy.
Strong words from the DOJ.
Very strong. The lawsuit itself is quite direct, stating that Visa uses its monopoly power to squash innovative alternatives to its debit network. These are very serious accusations coming from a powerful regulatory body. They suggest that Visa's dominant market share isn't just about having a superior service or a strong brand, but maybe about structural advantages that actively hinder competition.
And this isn't the first time Visa has faced this kind of scrutiny or litigation, is it? There's some significant historical context here that maybe makes this current lawsuit feel even more potent.
You're absolutely right. This isn't a new challenge for Visa at all. Both Visa and MasterCard previously settled a massive, protracted 20-year litigation battle.
20 years?
Yeah, for a staggering $5.54 billion with merchants over interchange fees, those fees merchants pay when you use a card.
Right.
There was also a notable $30 billion settlement proposal aimed at capping processing fees that was later rejected by a federal appeals court, sending it back. So these precedents highlight a clear, long-running pattern of legal challenges questioning their market practices, particularly regarding their network rules and the fees they facilitate.
It suggests that the current DOJ lawsuit is really part of a longer narrative concerning their market power and how they wield it within the payments ecosystem.
Exactly. And as one source pointed out, the sheer financial numbers we discussed earlier, the 55% net margin, the 80% gross margin, are so extraordinary that they naturally raise questions about how such dominance is achieved and maintained, and whether it's always purely through fair competition in an open market.
These are definitely some serious accusations and significant historical precedents. So, how does Visa officially respond to these claims from the Department of Justice, especially given their CEO publicly called the lawsuit meritless?
Well, Visa's CEO, Ryan McInerney, he directly addressed these allegations on that Q3 earnings call we've been referencing. He stated quite emphatically, quote, "The lawsuit is meritless and shows a clear lack of understanding of the payment ecosystem in the United States."
Okay, strong pushback.
Very strong. He firmly asserts that, quote, "Visa competes for every transaction in a thriving debit space that continues to grow and see new entrants." Their defense really centers on the idea that their success is a direct result of robust competition, providing superior product offerings and delivering market value to both consumers and merchants, not because of anti-competitive behavior.
So they argue the market is competitive.
They would argue that the market is dynamic, with various payment options available from old standbys like cash and checks to newer digital wallets, buy now, pay later, peer-to-peer services like Venmo or Zelle. They'd say they have to compete against all of those.
Okay, so from an investor's perspective, this presents a really fascinating dilemma, doesn't it?
Absolutely.
On one hand, you have this incredibly profitable company with strong growth, impressive innovation in key areas, and what seems like an almost unassailable market position. On the other hand, you've got this persistent risk of significant regulatory intervention or massive, costly lawsuits looming in the background.
The overhang, yeah.
One source we looked at explicitly notes that if the whole monopoly status makes an investor uncomfortable ethically, or if they're genuinely concerned about the possibility of forced breakups or profit erosion from huge legal fees, then maybe that's a reason not to invest.
A valid concern for some.
But interestingly, the author of that piece personally feels that it's unlikely Visa will face truly devastating consequences anytime soon. They suggest Visa's immense wealth and sophisticated legal resources help protect their position.
Right, the too big to fail or too powerful to fight argument, maybe?
Kind of. And this highlights that ongoing tension between fundamental business strength and those external regulatory pressures. It's a key lesson in critical thinking for any investor or even just an observer of big corporations, isn't it?
It really is. And the advice offered in that particular source is quite pragmatic, maybe even a bit cynical.
What's the advice?
Essentially, consider buying Visa stock when anti-competitive news like this DOJ lawsuit spooks people and causes sell-offs, or during broader economic downturns when everything gets cheaper.
So buy the dip caused by regulatory fear.
That's the strategy suggested. It basically capitalizes on temporary market dips, betting that the company's underlying strength, that hyperscaler network effect, its profitability, its ability to navigate these legal challenges, will ultimately prevail in the long run. It implies that while the regulatory concerns are real and definitely need to be monitored, their immediate catastrophic impact on Visa's long-term profitability is often overestimated by the market in the short term, creating potential buying opportunities for those with a strong stomach.
Interesting perspective. Okay, so beyond these regulatory challenges, the global economy itself always presents headwinds, right? We've got inflation concerns, geopolitical tensions, consumer confidence swinging up and down. How is Visa's business model holding up against this kind of broader economic uncertainty, especially given its truly global reach?
That's always a key question. The Q3 earnings call actually emphasized the remarkable resilience of consumer spending, even with continued macroeconomic uncertainty lingering in various regions around the world.
So people are still spending.
Apparently so. In the U.S., their payments volume was up a healthy 7%. Interestingly, e-commerce grew even faster than face-to-face transactions within that.
Okay, continuing the shift online.
Right, reflecting ongoing digital adoption. They also noted that both discretionary spending, things you want to buy, and non-discretionary spending, things you need to buy, remain strong and consistent across all consumer spend bands, from low income to high income.
That's a key indicator.
It is. It suggests underlying economic health, or at least continued spending activity, despite broader concerns you might read about the economy. It suggests that even when other sectors might falter, the fundamental act of spending, especially digitally, continues relatively unabated, which of course directly benefits Visa's transaction-based model.
So consumers are still spending and shifting more online, which reinforces the value of Visa's digital infrastructure. But are there any specific geographic areas or types of spending where they're seeing more sensitivity to these macro factors? It can't all be rosy everywhere, can it?
No, you're right. There are definitely some nuances, as you'd expect from a truly global company. While their overall international payments volume grew 10% globally, certain regions or flows showed sensitivity. For instance, they mentioned U.S. outbound travel has been sensitive to the strength or weakness of the U.S. dollar.
How so?
Well, when the dollar strengthens significantly, U.S. residents might find international travel relatively cheaper, which could boost cross-border spending abroad. But if the dollar weakens, travel becomes more expensive, potentially dampening those flows.
Okay, currency matters for travel flows.
Definitely. Similarly, they noted that currency weakness in parts of the Asia-Pacific region has impacted travel there, as it makes travel more expensive for residents using those local currencies. There's also just general month-to-month fluidity you see due to factors like the timing of holidays. Easter and Ramadan were mentioned for Q3, and specific high-volume travel corridors, like the traffic between Canada and the U.S. These factors can cause short-term fluctuations, even within an overall strong trend.
So they're clearly not completely immune to macro factors like currency swings or regional economic softness. But it sounds like the underlying consumer activity combined with their highly diversified global footprint provides a pretty strong buffer against more localized or temporary economic shifts.
I think that's a fair assessment. And looking again at cross-border volume, which is such a critical revenue driver for Visa, it grew a robust 11% if you exclude intra-Europe in Q3.
Still double-digit growth.
Yeah. And while there was that month-to-month fluidity due to the factors we just discussed, shifting holiday dates, currency fluctuations, specific travel corridors, the overall level of cross-border volume remains strong. And importantly, they stressed it's consistently above pre-COVID levels now.
That's a key milestone.
It is. It indicates a sustained recovery and continued growth in international transactions, which is often seen as a key indicator of broader global economic activity and interconnectedness.
That's a powerful statement about their global reach and their ability to adapt. How do they actually maintain this level of resilience and adaptability in such a dynamic, sometimes unpredictable environment? Is this where that hyperscaler concept we mentioned earlier truly comes into play?
It absolutely is. I think that's the core of their strategic positioning.
Yeah.
Visa consistently highlights its ability to anticipate changes in buyer and seller preferences and then swiftly deploy solutions that meet evolving client needs. Their CEO, Ryan McInerney, used that term hyperscaler on the call, describing Visa as a platform that allows anyone involved in money movement to build on its network.
Like cloud computing, but for payments.
Exactly. That's a great analogy.
Yeah.
Just as AWS or Microsoft Azure provide the foundational infrastructure for software developers and businesses globally, Visa provides the foundational digital rails, the security layers, the data insights, and the connectivity for financial institutions, fintechs, governments, and merchants all over the world.
The scale is just immense.
It really is. This network stands across more than 200 countries and territories. It supports transactions in 150 different currencies, and it connects nearly 5 billion credentials, cards, tokens, whatever form they take globally. This vast, adaptable infrastructure enables them to continually find new ways to connect buyers and sellers, buffering them against those localized or temporary economic shifts, and ensuring their sustained relevance across the incredibly diverse global payments landscape.
It's really about being an indispensable platform for anyone involved in moving money, almost regardless of the specific method or the location, and being able to scale that service almost infinitely.
That seems to be the goal, yes,
Yeah.
being the ubiquitous enabler.
Wow. Okay. So today, we've taken a truly deep dive into Visa. We've uncovered a business that is not just incredibly profitable sometimes, as one source put it, too incredibly good,
Yeah, memorably put.
but also one that's relentlessly innovating, albeit perhaps in a strategic development way, across consumer payments, commercial solutions, and even the new frontier of stablecoins. We've seen how its sheer scale and operational efficiency contribute to those almost unheard of financial metrics, even as it navigates these really complex regulatory challenges that question its very market dominance. It's a company that truly seems to exemplify the phrase, "The house always wins in the world of payments," but with a constantly evolving strategy to make sure it stays the house.
That's a good summary. So for you, the listener, maybe consider this. Visa's CEO talks about being a hyperscaler, this platform that enables anyone in the payments business to build on its stack. Now, as digital commerce continues to evolve at lightning speed, we're talking AI agents doing shopping, new blockchain technologies emerging, direct account-to-account payments gaining traction in many markets. Will Visa's strategy of broad enablement and quiet infrastructure dominance keep it ahead? Or will the very innovations it embraces like stablecoins, like AI agents, eventually shift the competitive landscape in ways that even this giant can't entirely control? Could the tools they provide empower new competitors or new models that challenge their central position?
That is something profound to ponder the next time you tap your card or your phone or send money across borders. Thanks so much for joining us for this deep dive into Visa's powerful, complex, and definitely evolving world.
Thanks for digging in with me.
Until next time, keep digging, keep learning, and stay well informed.